Okay, so bank examiners bring camels to audit. When they go to audit the bank, they bring their camels. So camels is an acronym. The C is capital adequacy. Capital adequacy. The A is asset quality. M is management. E is earnings. L is liquidity. And S is sensitivity to market risk. Sensitivity to market risk. All right, so these are this just identifies the areas that the government is going to check out when they go into a bank and audit their books and check out their operations. Capital, assets, management, earnings, liquidity, sensitivity, you kind of look at for a business too, right? So because they are a business, that's one reason for that. So we've got 3 government entities that handle these things. Number 1 is the comptroller of the currency. And they are the ones who audit and monitor national banks. Number 2 is the Fed. So the Federal Reserve, the central bank. The Fed handles member state banks. These banks have their charters in specific states. National banks, we're thinking Wells Fargo, JP Chase, all those big banks. And then the FDIC. Who was it that had just had a memory come back to me? Was that you, Alex?
Yeah, my mom works for me.
Yeah, can she come in and talk?
I can try to get her. She's in.
Yeah, we talked about that before.
Yeah, she's in Washington, D.C. right now. So.
All right. Why don't you send her a text right now? Got your phone?
Yeah, I do, but I'm not going to send it towards you.
You have express authorization to send her a text. Just say, Mom, I'm in class right now. The professor asked me. I'm serious if you're up for it. Unless you don't want to bother her for some reason.
I don't know if she'll answer right away.
No, I don't need an answer right away, but I just want to kind of get the ball rolling.
Okay.
You can say, my professor, I'm in the middle of class right now, and the professor's, if you come speak to our class.
Before the year's over.
Yeah, because I think when we talked about it, I think we talked about doing it for money banking. But,
Yeah, we're going to that.
so that's why I'm having you pull out your phone right now, because I don't want to have that happen. So I'd like to have her come talk. That'd be cool. All right, so while you're doing that, so these are insured, the FDIC covers insured non-member state banks. So we have like over 6,000 financial institutions, right? It used to be 12, but it's shrunk over time. I think we did that. That was one of our chapters in the money and banking. So this is how they kind of carve up the banking system between these 3 government entities. So one thing is that they do share information, which sometimes government entities don't do very well. But in this case, they have a pretty good information flow. So they share information with each other. And that's, of course, partly because there's so much interrelatedness between, like, if you're a non-member bank or a state bank or a national bank, I mean, this guy might be borrowing funds at the federal funds rate from Wells Fargo or whatever. So they do have interaction between each other. And so they do, this is just how they share the burden of doing the audits. Okay, so on sensitivity, I'm going to show a short video here in a second. And one of the things they do is called a stress test. So how sensitive are they to market risk? And they literally kind of run through a kind of a artificial shock to the system. Like, what if you lost 10% of your assets? And they do a computer algorithm using all of their information, and they take away 10% of their assets or whatever, and they see what happens to their capital requirements. How far does it fall? Has to be within a certain threshold for them to pass those stress tests. So they kind of go through these simulations of faking an issue. All right. Let's see. Let's do one short little video. Okay, this is a 10-minute video. It's not actually. This is a really short one. You know, maybe we'll start with this one. This is only a minute long. And then we'll do the other one. This is actually kind of an advertisement for a product that they can sell banks. But I always love the fast draws.
You need to find a comprehensive solution. Whether you're a financial
Okay,
analyst,
let me get the volume down
community
here.
banker, officer at a large bank, or treasurer at a corporation or municipality, you're very interested in the safety and security of faced with many challenges and pressures to succeed. You need to find a comprehensive solution. Whether you're a financial analyst, community banker, officer at a large bank, or treasurer at a corporation or municipality, you're very interested in the safety and security of selected banks. Now there's a tool that quickly sifts through and analyzes the data banks provide to regulators. It's TDS Bank Monitor, a robust online service, complete with mobile apps, that lets you create the tools you need to measure risk at FDIC institutions, bank holding companies, credit unions, even international banks. Its flexibility and ease of use is unparalleled. Use the search tool to set up a watch list. Develop custom analyses using numeric computations or logic algorithms. Conduct peer group analyses going back to 1995. And design and build customized scoring systems. The system's wide range of reports include the Bank Monitor Stress Index, Counterparty Quality Score, Capital Adequacy, as well as the Bank Monitor Shadow Canvas, including those weighted for FDIC CFR Deposit Assessment Risk Category computations, and so much more. No other single product provides the range of data and analysis that TDS Bank Monitor does, and trained personnel are available to advise clients. Get the best bank surveillance and risk analysis tool available. Contact TDS Monitor today for more information or a full demo.
All right, brought to you by TDS.
I'm Tom.
I like the way they kind of hit all of the various issues that bankers need to be thinking about. So this next one's kind of got some animation, not so exciting of a voice, so don't fall asleep on me, but the content is good. And so some of these regulations are in our chapter, and this one deals with the Basel regulations.
Welcome to this film on Basel III. I intend to zoom in on the main axes of this new regulation and on the main changes.
You know what? This guy needs a faster voice.
Let's start with the first part.
How do I do
Basel
that?
III, as the name already indicates, cut on from Basel II. Basel II was mainly focused on the loan capital. When lending money, banks engage in activities bearing some level of risk. For this, Basel II presupposes that some risks come with lending, and part of the capital has to be set aside to cover these risks. To illustrate this, we will take BNP Paribas Fortis as an example, using some round numbers to render the comparison somewhat easier. Let's use 200 billion of loans as the starting point. Basel II states that some risks are associated with those loans. Basel III continues this reasoning. This risk is not equal to all of those loans. For this, the loans are weighted in order to arrive at the total amount of risk-weighted assets. Returning to the 200 billion of loans, some are weighted at 100%, some at 50% or less. In this instance, 200 billion of loans give us 100 billion of risk-weighted assets.
Okay, pay attention to that risk-weighted asset. You're going to have some problems that are going to be similar to that for risk weighting.
Basel II told banks to set aside 2.5% of the risk-weighted assets, or 2.5 billion in this case. Basel III is using the same concepts, but imposes not 2.5%, but 7%, or even more, depending on the nature of the activities and the type of bank. This was the first axis, leading to a considerable increase in the required capital for banks. The second element Basel III adds relates to the size of the balance sheet. Last years, we have seen balance sheets of banks growing significantly. Basel III insists on limiting this and even stimulates banks to take initiatives to reduce them. The way to impose this is by putting a limit on the size of the activities a bank can develop compared to its own capital. For this, a leverage ratio has been developed. The third element added by Basel III, probably the most important one, is liquidity. Liquidity is represented by this bucket. The bucket is not filled up with water, but it represents liquidity, so it contains euros and cents. What is liquidity to a bank? A bank receives deposits and grants loans. Every day, the bank disposes of a certain level of cash through its activity of collecting deposits and by providing cash to clients while granting loans. It's very likely the bank will not be in equilibrium at the end of the day. If it has more deposits than loans, it will deposit part of them with another bank. If it has granted more loans than it received deposits, it will go for a loan with another bank via the so-called interbanking market. Of course, it's key for a bank to have equilibrium between its loans and deposits for each period of time. To be sure such equilibrium will exist, Basel III has developed a specific regulation. Before zooming in on this, I will first explain the metaphor bucket used in this film. As we saw, the bucket fills up with euros and cents. So each time the bank receives a deposit, the bucket will fill up. Each time the bank grants a loan, some liquidity will leave the bucket. Why? Because the related cash will be with the corporate client, with the individual, or with the person who sold a good to this individual. Still, another aspect requires an explanation before we can tackle the regulation itself. The in- and outgoing cash flows are very typical to each bank. I can explain this as follows. A savings bank is specialized in the collection of deposits. Its bucket will fill up at high speed and can even have an overflow. At the other end of the spectrum, a merchant bank specializing in lending activities to large corporates will see its buckets empty at high speed. It's mainly the speed of the bucket filling up and emptying that is typical for each bank. For this, Basel III imposes standardized stress tests on all banks. In fact, Basel III compels banks to have sufficient liquidity available during a period of 30 days of stressed conditions. In normal conditions, one can expect a loan to be reimbursed completely at its maturity date. This is not the case during the stress test window of 30 days. Then only 50% serves to reimburse the bank, and the bank has to inject the other 50% in the economy by granting new loans. So for loans at maturity, 50% leaves the bank again. Let's have a look at the treatment of deposits. The first category is deposits from individuals and from small and medium-sized companies. Basel III states they leave the bank at 5% or 10%. So during the 30-day stress period, 5 or 10% of those deposits will basically walk out the door. For deposits received from banks, the runoff percentage is at 100%, meaning they will leave completely before the end of the stress test. Of course, a third category exists, the one relating to deposits from corporates. Here, a very important notion is introduced by Basel III. 25% or 75% of the deposits of corporates will leave, depending on the existence or non-existence of an operational relationship between the bank and the corporate. In other words, if a bank has 10 billion corporate deposits and an operational relationship with these clients, 2.5 billion will be lost. Suppose no operational relationship exists. The bank might even lose 7.5 billion of these deposits. The result is a 5 billion difference in the stress test for Basel III. We'll come back.
Yeah, let me pause on that for a sec. Operational relationship. What do you think? What does that mean? If the bank has an operational relationship with the business. Yeah.
They continually take out loans and pay back.
Yeah, that's basically it. So that's not always true. So sometimes you might just hold an account there, but you actually don't do business there. When you do business there like a loan, then that means that the business is providing financial statements, probably on a regular basis, like annually at a minimum, to the bank. So the bank has a lot better grasp of the company when they have an operational relationship with them. And so you can see how some of this regulation stuff gets pretty confusing pretty fast, or pretty complex anyway, because depending on various circumstances, it might be okay for one bank to not have as much liquidity and another bank needs more liquidity. And so all these factors start to kind of roll into it. Questions on that? All right.
On this Basel III tendency to bound towards more traditional activities. I explained that at all times, enough liquidity has to be available to comply with the stress test. This will put pressure on the net results. Remember also that the required increase in the capital must be set aside. So we are dividing something becoming smaller by something becoming larger. This leads to a reduction in return on equity for banks. This is a very tangible Basel III impact on banks. The primary challenge to a bank is the managing of the equilibrium between loans and deposits. This is a fundamental daily challenge that will drive the banks. As I have explained, banks face a profitability challenge. Revenues from cross-selling will be welcome, and on top of this, cross-selling will be required to manage the equilibrium loans deposits. However, this cross-selling also leads to more operational intimacy, the kind of operational relationship we referred to earlier. So, while managing between deposits and loans, cross-selling will also be key. The operational intimacy this will bring will help to retain the required liquidity levels for the stress test. So, this is very fundamental to the required calculations for Basel III, as well as for the continuity of the bank. This leads us to our statement that banks have to have complementary activities to the business of granting loans and collecting deposits. Cash management is a good example. Cash management is key in this context. Factoring is also a complementary activity. The former Fortis factoring entity has now returned to BNP Paribas Fortis to become part of the service offered to our clients. With what you have just seen, I hope I have provided you with an overview of what Basel III is all about, how it impacts banks and the shifts it will bring to the interaction with their clients. This means that banks will work on a closer relationship with their clients and put more emphasis on traditional banking activities. For your attention.
Thank you. Okay, questions on the video? So that's one of the regulations that's in your chapter that kind of shows how what the government's doing. So I want to kind of tie that back to adverse selection and moral hazard. You know, it's kind of why do we got the government in there? So the government regulation hopefully addresses number one, adverse selection. If you're a risk-loving entrepreneur, is banking the right place for you, the banking business? Does that sound a good place for you to go, knowing that you have a lot of government oversight? Probably not so much, right? So it kind of repels risk. So in the idea of protecting the public interest, I guess if we think the banking system should be solid, risk-loving entrepreneurs are less likely to want to be in banking. So from an adverse selection standpoint, we're going to hopefully be attracting risk-averse entrepreneurs, right? So that's a good thing. So pre-contract adverse selection, who's going to be attracted to this industry? Probably not be the crazy pioneers that are better off maybe doing some other things anyway. Moral hazard. So these regulations, the regs have stuff like cease and desist orders. Cease and desist power. Fines, penalties, right? So they carry a pretty big stick. They can force write-offs. They can basically tell the bank, you need to sell this asset. And the banker might be saying, I know this person's gonna pay off. You know, they're in town for a long time, their family's wealthy, you know, don't worry about it. The government can literally say, you gotta sell it. You gotta turn this into cash now. That's not the way most businesses run, right? I mean, there's not businesses, the government's not usually stepping into operations telling Auto University what they must sell or do, or Pizza Village on Main Street. You gotta sell it. You gotta sell this piece of. I'm gonna help. You know, basically they're kind of right in there, being fairly invasive and carrying some decent power. Cease and desist. You need to stop doing that. You need to stop doing that behavior. You can't do it anymore. Well, but I thought it would be good and helpful for my clients. I don't care. Stop it. Just like a mom and dad, right? Kind of that heavy power. All of that to address moral hazards of banks, so that, again, in an effort to protect the public and to protect depositors' interests, there's a little bit heavier hand here. All right. So on the management part here, they have a ranking system. So you guys can just add this. I just wanted to kind of leave that stuff up. So for management, you guys can draw a line over there. There's a risk rating of 1 through 5. So the banker's going to come in and look at your management. You're wondering, well, how are they going to do that? They're going to have a little rating system. So if you get a 1, you've got an exceeds minimum capital. exceeds minimum capital. Number 2 is your adequate capital. Number 3, you are undercapitalized. Now, where am I going with this? Do you want to be a 1 or a 5? 1, right? So you're starting to see we got the capital. So undercapitalized, you're not meeting the minimum. Fail to meet the minimum capital standards. Number 4, you are significantly undercapitalized. And number 5, you are at this critical stage, critically undercapitalized. And then number 5 is going to call to action. So there'll start to be restrictions for sure if you get to this stage. Restrictions on deposit interest paid. And it's going to prompt corrective action. So then they're going to go into their bag of tricks and bring out the stick. You're going to get pounded to correct it. Or, importantly, the owners of the bank might have to open up their wallets and do their own little deposit into their banking system. All right, we will call it a day there.